Hello, this is Maila the Hybrid. Subscribe for regular updates. Today we're going to take a look at cash in transit. What is cash in transit as far as consolidation of financial statements is concerned? Cash in transit just arises in the case where the customer has paid for goods to a supplier, but the supplier has not yet recorded that amount. So the first step to do is to record that cash on the supplier's side. That means the supplier will have to debit the amount of cash, and then it will have to credit the amount of trade receivables on its books. And then we'll have to eliminate the intragroup payables and receivables. And this arises when we are just consolidating. The second case. For the first case, actually just recording cash and reducing receivables, that's just on the separate financial statements. But when it comes to consolidation, you also have to eliminate the intragroup receivables and payables. So all have to do was just two entries of double entry. The first one is to recognize cash not yet in the seller's hands, and then to eliminate the receivables and payables. And we are done. So let's take a look at double entries. So first, debit cash, then credit trade receivables. And this will be to recognize the cash in transit, the cash not yet in the supplier's books. And then second, we'll have to debit the trade payables. This means we eliminate the intragroup payables. And I just have note one thing. Since the customer has already paid for goods, then it will have already adjusted its trade payables for the cash that it paid for. And so this amount of trade payables will be the right balance. So we credit trade receivables by the same amount. So what is the overall effect now? The overall effect here is just debit cash, and then we'll also have to debit trade payables that we are right with it, this one, and then trade receivable appears twice on the credit balance. So we'll take this one plus this figure here, and we'll obtain the total figure, and this is the correct balance. So if you are conversant, you can just proceed with this last entry. Then let's look at the question and solve it. Just be patient a bit. PP Limited, a parent, usually sells goods to its subsidiary SS Limited on credit. At the end of the financial year, SS had paid $2,000 to PP, but PP had not yet accounted for it. This is what we call cash in transit. Then, SS's trade payable stood at $7,000 as at the year end. Since SS had paid that amount, that means SS had recorded the value in its books, had recorded the transaction. That means SS credited cash and debited trade payables and then arrived at the figure of $7,000. So this trade payables figure is the right amount when it comes to separate financial statements. So show journal entries to eliminate the intergroup transactions in the statement of financial position of the group is at the year end. Now, our two steps. The first one, debit cash, that is cash in transit, $2,000, and then we reduce the amount of trade receivables by crediting them by the same amount, $2,000. Narration here is about recognition of cash in transit. And then we eliminate intergroup payables and receivables. So our trade payables was $7,000. And now our trade receivables will be the same $7,000 because before it could have been $9,000, but after crediting by $2,000, it's now $7,000. The overall effect, first of all, this is to eliminate intragroup trade receivables and payables. What is the overall effect now? Debit cash by $2,000, as we see up here, and then debit trade payables by $7,000, and trade receivables has been credited twice, $2,000 here and $7,000, which gives us a total of $9,000. So this is how we account for cash in transit. Now be ready. In the other videos, I'll just show the combination of cash in transit and goods in transit in a single question. Alright, until next time. Bye and thank you very much. Remember to subscribe to the YouTube channel.